What is up, you guys? Pete DiCarlo here, teaching you how to build your portfolios one trade at a time. Should you be buying stocks right now? This is a question that I get a lot from you guys because right now the Nasdaq is way above all-time highs. The S&P 500 and the Dow Jones are pushing their way up to all-time highs. And honestly, the economy and the state of the country is not really, any different from where it was back in March when we saw those big lows. As well, there are a lot of first-time investors who are seeing their first crash and actually their first recovery from a crash as of now. And thanks to the United States government for giving everybody a stimulus check, we're actually seeing a lot of first-time investors as well because of this stimulus check on the Robinhood and Webull platform, and everybody's saying, are stocks going to get to where they were back in March, or should I just be buying right now? And I'm not going to go in this video specifically into why I think the market's going to crash, when it's going to happen, and what the reasons are. I actually made a video on this a couple of months ago. You guys can watch it there. In this video, I want to go over the main 3 factors on what you need to think about if you're going to be taking positions and starting long-term positions during these volatile times. Now, the narrative of should I be buying stocks right now is going to change if you're a long or short-term trader or investor. Obviously, if you're a trader, you're going to be buying and selling stocks no matter what the market is doing. This video is going to be geared more towards long-term investing. Now, before we start, actually, this should go without saying, but do not invest any money that you cannot afford to lose, right? If you're investing, you should have 6 months worth of your bills sitting in a savings account just in case anything happens. I know we all want to make money, we all want to invest in the stock market, but taking care of yourself and your well-being is more important than any of this. As well, overall dollar cost averaging is probably one of the best ways to invest in the stock market if you just want truly passive income. For those of you who don't know what dollar cost averaging is, essentially you do your research, you find say maybe 10 or 20 companies that you want to invest in for the long term, and every single paycheck you buy an equal proportion, whether the stock is up or the stock is down, of that company that eventually averages out to a specific price over time. And this is one of the best ways for you guys to invest in the stock market if you don't want anything to do with actively trading or, managing your own money over time. But for those of you who are here, you probably want to be in charge of your finances. You probably are the ones who want to actively, invest. And so these are the main things that we're going to go into now that hopefully will give you a better idea of if you should be investing in the stock market and starting positions right now. Another big point that I want to get out of the way is the idea of capital appreciation versus capital conservation, right? Conservation of capital and capital in general is just a very fancy way of saying money. Capital conservation or conservation of money is literally just holding on to the money that you have. Usually you're going to be in a conservation mode when there's an economic downturn or the market is selling off because you're trying to conserve what money you have. Remember, the way to make more money in the stock market is with money. And if you're constantly bleeding out and hemorrhaging money, it's kind of hard to make gains in the stock market. The other is going to be capital appreciation. This usually happens in a bull market, and this is when you're in a phase where you're actually trying to grow your money. Now, yes, you can actually grow your money in a down market, and a lot of people do this with hedging or options, and I'm going to make a video on this in the future, but you're either in capital appreciation or capital conservation. There's a really important difference, and that's what you need to know going into the rest of this video. And the first thing we're going to talk about is your age. And for a lot of people, that might not really, be a thing. What does age have to do with investing? Well, it has a lot to do with investing because in this example, let's take somebody who is 30 years old, right? Maybe they have about $10,000 sitting around. They want to start investing. If somebody who's 30 years old invests in the stock market and it dies 20, 30, 40, 50%, not the end of the world. That person won't be able to just pull their money out of the stock market unless they want to take huge losses, but they're young, right? Over time, especially if they keep averaging down, they're going to turn a profit as long as they're buying quality companies. Now, on the other hand, let's take a 62-year-old kindergarten teacher. She's about to retire in 3 years. She has about $250,000 in pensions, in savings accounts, or just other means of money. This person, she's not going to want to be buying stocks right now because she has to be in capital conservation. The young person is going to be in capital appreciation because who cares what happens short term? They have a lot of time on their side. But the person who's going to retire in 3 years, in this instinct, the kindergarten teacher, they're kind of in capital conservation because let's look at it this way. Say her $250,000 in assets, goes down 30, 40, 50% like we saw a couple of months ago. That's not good if she wants to retire in a couple of years, because there's three things that she has to do if that happens. She either has to, one, sell all of her stocks for a big loss and conserve what capital she has so she can eventually retire off of it. She could end up retiring, but just with half the money or just nothing at all and leave it in the market and hope for it to rebound, but that's not good. Or she'll be forced to work another 4 or 5 years until the market recovers. All of these are not good, right? If you're somebody who's been working 30, 40 years, the last thing you want to do is work another 5 when you've been, saving all this money for retirement just for it to get cut in half because of, economic situations like we have right now. So age has a lot to do with it. If you are somebody who is under 55, if you're not planning to retire within the next 10 years, then you can be buying stocks right now. If you're somebody who's going to retire in the next 3, 4, 5 years, you need to be in capital conservation mode, and you should not be buying up at these highs, in my personal opinion. This is why you normally see older people, the older that they get, the more they put their money into real estate or bonds or buy gold. This way it can mitigate the amount of losses that happen during an economic downturn, but it's also going to kind of cap the amount of gains you have, because your portfolio is not full of growth stocks or tech stocks or any of these companies that get high yield returns every single year. Now, the next thing to think about is going to be your risk tolerance. This is something not a lot of people think about. Risk tolerance is different for everybody, right? If I were to lose 30, 40, 50, 60, I actually lost 70% of my portfolio back in March. And it didn't really matter to me because I have a pretty high risk tolerance. I just kept averaging down. I knew the companies I had were great companies, and I didn't really lose sleep at night. But if you're somebody who loses 10, 20, 30% of your portfolio, you're checking your phone every day, you're depressed, you're not a good person to be around, and you don't want to be buying stocks right now because of volatility. You need to put a higher importance on your mental health and your relationship to the stock market over how much money you can potentially make. And risk tolerance also has to go with if you're making money, right? Say you were somebody who wanted to get into Tesla when it was $1,000, and you did. You took a position and you planned to hold it for 2 years. And then a couple of days later, it ended up ripping 22%. If you have a low risk tolerance, you might say to yourself, 22%, that's huge. I'm just gonna take a quick profit, and then when it sells off, I'll buy back in. And then look what happened. You missed out on almost a 44% move just a couple of weeks later. The biggest problem with long-term investors, and this is a big problem with myself, is that we try to pick the flowers from the investment seeds too early, right? So imagine that you're planting a bunch of flowers and 1 or 2 of them bloom, and you just start to pick the flowers and then the plant dies, when in reality you should have waited for that plant to fully bloom. You would have gotten 2, 3, 4 times the amount of flowers from just that seed that you planted. And this goes for the stock market as well, because I know a lot of people, like I said myself, where I will start a long-term investment, stock will go up 10, 20, 30% fairly quickly, and I will just cash out and hope to rebuy back in, and it just never happens. So risk tolerance is something that's very, very important. If you have high risk tolerance, then go ahead. You can be buying these stocks right now and holding for the long term, as long as you're okay with maybe losing 20, 30, 40, 50% of your portfolio short term. But if you're somebody who cannot live like that, if you're somebody who's gonna be checking your phone 10, 20, 30 times a day, and you are going to react upon the way the stock market is acting, that's not the kind of relationship that you want with the stock market, and you probably shouldn't be buying right now. And the next thing is going to be position sizing. And yes, position sizing is not just something for traders, it's also something for long-term investors. And this is something that I do with every long-term investment that I actually take. For instance, if you are somebody who has $100,000 in your portfolio and you want to start some positions in the market, don't just buy $100,000 worth of stock. Do the smart thing, put about 50, 60, at the most 70,000 into the market. Keep about at least 30% on the sidelines, just in case we get these lows that come back or a big sell-off happens. You can actually average down on your prices, and therefore you're not gonna have to worry that you bought at the top. A rule of mine, whether I'm trading or long-term investing, is buying in threes. So for instance, I bought Smile Direct Club a couple of months ago. I knew that I wanted $10,000 total in this position. My first buy-in was for $3,300. My second buy-in was for $3,300. And guess what? The stock ripped and I never got to buy in with my final $3,300. but that's fine because I actually limited my risk by averaging down slowly into the position. Multiple buy-ins is very important during volatile times because it gives you the ability to get the best possible price. Now for me, I never really average up, so it's not something I'm going to go into detail in this video, but averaging up is kind of the same thing. The way that I see it is you don't want to just throw all your money into a position on the first buy-in because there's so many different things that can happen, especially in a market like today. The moral of the story is that if you are younger, if you have a healthy relationship with the market, if you're okay with volatility or losing half of your net worth in a couple of months, buying into the stock market right now is not the worst idea, right? Nobody can time the stock market to a T. I am a swing trader, and even I will tell you, you can't time the market perfectly. But I hope that this video helps. If you guys want, I do have a free introduction to the stock market course down in the description below. It's 100% free, and if you want to join my private stock market academy group, I'm giving away 7 days for free. The link will be down below. Thank you guys for watching. Make sure you hit like and subscribe to this channel as well. Thank you guys for watching, and until next time, I will see you.